Guys, let's carry on. So, guys, in a question, one of the things that's not really in any of the 4861 tests is what happens if you sell shares in a foreign company. So let's just create an example now. So let's imagine you own 20% of shares in B PLC. So it's a foreign company. Cost 100,000. Okay, actually, the maker cost 1,000,000. Okay, and we sold it for 600,000. So how much would your loss be, guys? 400,000. Everybody comfortable with that? Is that cool? So just to make sure that I'm covering a whole lot of stuff today, we've got paragraph 64B of the 8th schedule. So you know that with dividends, it's exempt if you own 10% or more of shares. So have a look at what this section actually says. And I just want you to make sure that you've tagged this section as well. So it says, subject to subparagraph 4, person other than a headquarter company must disregard any capital gain or loss. So this could be a profit or it could be a loss. Is this all right? Okay. In respect of the disposal of any equity share in any foreign company. So it's only in relation to a foreign company. It says if that person held an interest of at least 10% of the equity in voting, right? You guys comfortable with that? So just like you've got the exemption for dividends where you own 10% or more. This is if you own 10% or more. Held the item for a period of at least 18 months prior to that disposal. So the fact you needed to have owned it for at least 18 months. Okay. Unless that person is a company that interest is acquired by a person other than the company that forms part of the same group of companies. And that person, the other company, aggregate held it for 18 months. And that interest is disposed of to anybody that is not a resident. So you need to sell it to someone that is not a resident. So if you ever see a sale of shares in a foreign company, you should come have a look here. Does everybody understand that? So what I just want to do is I'm going to start off with the stuff. So I've already said to you, guys, if you sell local shares at a loss and there's dividends in and around the period of sale, you've got section paragraph 19(1)(b). Everybody happy? You've got 64B, which is for sale of shares in a foreign company. And what I also want you guys to have a little bit of a look at is this section, which is 19(1)(a), before I actually do the liquidation with you. So as schedule, so I want you to have a look at 19(1)(a). Sorry. So 19(1)(a) is for liquidation. So losses on liquidation. So look what it says here. It says where any person disposes of a share in a company as a result of the acquisition by that company from that person of any shares part of any liquidation, winding up, or deregistration of that company, that person must disregard so much of any capital loss resulting from the disposal as does not exceed any exempt dividends. Does everybody see that? Now, bearing that in mind, I'm about to do a liquidation with you. Is that all right? So what happens if you have a loss when you liquidate? Any amount of exempt dividends must get set off against the loss that is suffered. Are you guys comfortable with that? And I'm going to show you that now. So let's go and let's do a question. So here we're going to do a liquidation. And I want to add something onto this question, if you don't mind. So let's put on here shares cost 100,000 Rand. Is that all right? So the shares cost 100,000 Rand. If you could add that onto your question. So this is on page 153. You could add on that the shares cost 100,000 Rand. So it says on 1 June 2019, Oz liquidated Wazardian. Since both Wazardian and Oz had cash flow problems, Oz was the only shareholder of Wazardian. The statement of financial position of Wazardian immediately before liquidation was as follows. Share capital, all contributed tax capital, 5,000. Reserves, 895, represented by cash, 300. Tools, 600. Carrying value. It says the cost price of the tools was 600, and the current market value was 500. The tax cost of the tools was 200, so there's your tax value. Wazardian sold the tools at the market value on liquidation. Now, guys, they've got a table there, but what I want to do is I just want to set it up the way that I've taught you to actually do it. Okay? So what have I done? I've said, first thing we need to do is we need to analyze opening share capital. And we need to have a dividends column and a not a dividends column. So looking at this question, guys, it's got share capital or contributed tax capital, 5,000. So how much is your contributed tax capital? 5,000. And which column? Not a dividend. And then you've got your retained income, guys. And where would you put your retained income? Retained income, is it a dividend or not a dividend? It is a dividend. Are you guys comfortable with that? And then what did I do, guys? I said we're going to carry on filling in stuff on this table, but essentially there's two things that we're going to be required to do. So number one is we're going to have to calculate accounting profit. And I said the other thing that you're going to have to do is do a tax calc. Do you guys remember? So let's have a look. So let's have a look from an accounting perspective. In the balance sheet, it's carried at 600. And from a tax value perspective, from a market value, it's 500. So when I sell it, how much profit or loss am I going to make? I'm going to make 100,000 loss. So when I do my accounting profit, I'm going to have a loss on sale equal to 100,000 on sale of it. And in the question, it says the tax value is 200. Cost is 600. So if I had to do like a tax calc and I've got income and I've got CGT, I'm going to have cost 600 less allowances to 400 gives me a tax value of 200 sold for 500. Therefore, I'm going to have a recoupment of 300,000. Are you guys comfortable with that? And amount of tax I'm going to end up paying, 300,000 times 28%. Gives me 84,000 rands worth of tax that's going to be paid. So guys, taking those two numbers up into the table, I'm going to have a loss on accounts and profit, which is minus 100,000. And I'm also going to have tax paid of 84,000. Are you guys comfortable with that? Which leaves him with 701 there, and it leaves him with 5,000 there. Are you guys comfortable? Now, because it's a company that owns this, what's going to happen? No dividends tax. So, if this was an individual, it would be different. But for this one, 701 is going to be your dividend, and 5,000 is going to be your CTC. And if I had to do a tax calc for this company now, I would sit there and say dividend received, 701, exempt dividend, 701. I'd say proceeds is equal to 5,000. Base cost, 100, because I told you to put 100 cost in. And how much would your loss be? 95. And what does that little paragraph say you must do? Let's read it again. It says, where a person disposes of a share in a company as a result that the acquisition of that company from that person of that share or as part of that liquidation, winding up, or deregistration, the person must disregard so much of the capital loss resulting from the disposal as does not exceed exempt dividends. So in this company, we've got a loss of 95, and we're going to add back 95. Paragraph 19(1)(a). Why? Because it says your exempt dividend 701. So up to 701 loss, we're going to add back. We can't add back more than the 95 that we've got. But you're not allowed to get that loss in terms of paragraph 19(1)(a). Do you guys understand? That's not in your assignment. But if you're going to get a liquidation in an exam, they'll give you one where there's a loss. Are you guys comfortable with that? If they told you this was an individual, your dividends tax would be 701,000 times 20%. Huh? If they told you you own 20% of the shares, it would be 701,000 times 20% times 20%. You guys comfortable with this? You happy? Liquidation, you comfortable with how to do a liquidation, or do you want me to do another one? Guys? Do you want me to do one more? Can I choose one that's a little bit harder? Okay. So I'm just going to create one. Is that all right? So let's have a share capital equal to 1 million. Let's have retained income equal to, I might not finish the examples that I'm doing, but can I show you some nasty stuff? 3,950,000. Let's do it that way. Let me have deferred tax. Let's make that 1.5 million. Okay. So can someone just add that up for me? 2.5, 6.5, 6,450,000. Is that all right? Is that okay? And then I'm going to have machinery. Let's put it at 2 million in the books. And let's put cost at 3 million and market value equal to 3.7 million, including VAT. So let me cause some stress in your life. Is that all right? And let's have trading stock 3 million. And let's make market value equal to 3.5 million, including VAT. Okay. And let's just make cash the balance. So cash should be 1,450,000. Actually, let's make cash 450, and let's make debtors 1 million. Okay, and let's just imagine that we only collect 800,000 debtors. Okay, and let's make liquidation costs equal to 50,000 bucks. Okay, sufficiently difficult. Folks? Okay, just let me explain what I've done here. You had tools in the previous example. Tools were an asset that was sold below cost. So I haven't put anything like tools into this question because essentially within a liquidation, you can get any one of these variations. They can either give you an asset that's sold below cost, which is the tools example, which I've just done with you. Are you guys comfortable? You can have a depreciable asset sold above cost. Is that right? You can have a non-depreciable, which I'm not putting into this question, but non-depreciables are very straightforward. Okay, you can have debtors, you can have trading stock. Okay, so, and then let's put in there that the let's make it CTC equal to 600,000. Is that all right? Because CTC doesn't have to actually have a thing. Well, let's make it. Let's rather do it this way. Issued 500,000 shares at R1. Okay, and you had a 1-for-1 cap issue. Is that all right? Okay. So now I'm just going to do all of the stuff. So the format does not change. So the first thing that you're going to do, guys, is you're going to analyze your opening share capital. Are you guys comfortable with that? So what you're going to do is you're going to say, I've got share capital. It was 500,000 issued at R1. So how much is my CTC? My CTC is 500. And my cap issue, what was the journal entry for the cap issue? Debit retained earnings, credit, share capital. So what's the other 500,000 going to be? The dividend. So if there's ever a cap issue portion goes into the dividend column because it came out of retained income. Are you guys comfortable with that? Retained income 3950. So what's going to happen? That's going to go into your dividend column. Guys comfortable? Okay. Let's imagine everything gets sold at market value. Are you guys comfortable with that? So I've got to do certain calculations. So I'm going to have an accounting profit calculation. Does everybody understand that? So one of the first things I'm going to do in my accounting profit calculation is I'm going to reverse my deferred tax. Is that all right? Because if I'm liquidating, am I going to have any deferred tax? I've got nothing. So I'm going to reverse out my deferred tax. It's going to be zero. I'm selling off everything. So deferred tax is a credit. So you're going to say debit deferred tax balance sheet, credit, tax, income statement. So now I'm going to have in my accounting profit a 1.5 million rand profit for deferred tax. So that's all you need to do with deferred tax. You need to reverse it back to your accounting profit. That's all you need to do. It's not difficult. Okay? So I wouldn't worry too much about deferred tax. Okay? Is there an equivalent tax calc? No, there's no equivalent tax calc. Are you guys comfortable with this? Next one, machinery. Market values 3.7 million, including VAT. So what you're going to have to do is you're going to have to work out what the value is, X VAT. Because 3.7 million times 100 divided by 115 means that it's sold for 3217391. Are you guys comfortable with that? Because the VAT is going to get paid across to SARS when you sell the machinery. So we're selling for 3217. Okay. Cost is 3 million. Market value 3.7. Oh, and can I make your tax value equal to 1.4 million? Is that all right? Sorry, I didn't give you a tax value. Can you just add a tax value on there for 1.4 mil? So guys, as far as my accounting profit is concerned, how much is my accounting profit? Book value is 2 million. Okay. Book value is 2 million. So my accounting profit is minus 2 million. It's going to give me 1217391, and that is going to be my accounting profit on sale of machinery. Are you guys comfortable with that? Cool. And then guys, in my tax calc, I'm going to have a cost originally of 3 mil. Allowances are going to be 1.6, give me a tax value of 1.4 sold for 3217,391. Guys, comfortable with that? So what's going to happen, guys? I'm going to have a recoupment equal to how much? $1.6 million. And I just want to set up properly. Your proceeds is going to be 3217,391 minus 1.6 mil. $1,617,391. And your base cost is going to be 1.4 mil. Guys, comfortable? Does this make sense? Just a normal calc. You just got to do it asset by asset. Back to the question. Next asset, trading stock. Cost 3 million, market value 3.5, including that. So 3043,478. Guys, comfortable with that? So in my accounting calc, what's going to happen? I'm going to have profit on sale of trading stock, and that would be 43,478. And in my tax calc, I'm going to have a deduction for my stock equal to 3 million. And then I'm going to have income from sale, and that's going to equal 3043,478. Guys, comfortable with that? Happy? Next one. I've got collect 800,000 rands worth of debtors. So what's my accounting profit, guys? How much is my accounting profit? So if I'm asking you, there's a trick. So what's the trick? If I only collect 800,000 debtors, what happens? You've got to still adjust for VAT, guys. Because what happens when you write off your bad debt? So in my accounting profit or loss, I have a 200,000 rand loss times 100 divided by 115, because I can get back that 15% of the VAT back on my debtors. So if I write off 200,000 rands worth of debtors, I get my VAT input, and I only make a loss of 173,913. Okay. And here, your debtors, it's the same scenario. Sorry. $173,913. You get 11 out, but the VAT you can't claim a deduction for because you've claimed it on your VAT return. Is that all right? I'm left with liquidation costs. In your tax calc, guys, your liquidation costs are just a dash because they're not in the production of income. But the liquidation costs will go into your accounting profit. So you will have a minus 50,000. Are you guys comfortable with that? But it's not tax deductible. So adding up my accounting profits, sorry, 1.5 million plus 1,217,391 plus 43,478 minus 173,913 minus 50,000 Gives me 2536956. And I'm going to go back and I'm going to put the 2536956 in my table. Is that all right, guys? I put the 11 on the tax code. Yeah, it's the same thing. There, the 173913. So, guys, essentially what we've got to do is we've made a CGT profit. How much? 217391 times 80% because it's in the company. Sorry. Times by 0.8. Put that in there. 174,349. Okay. Minus 173,913 plus 3,043,478 minus 3 million plus 1.6 million equals 1643 910 times 0.28 gives me 46294, and 46294 goes in as my tax payable. And then adding up this column, 500,000 plus 3,950,000 plus 2,536,956 minus 460,294. So your CTC is 500 and your dividend is that. And then if they say you own 20% of the shares and you're a natural person, if you own 20% of the shares, so if they told you you own 20% of the shares, it costs you 1 million rand for the shares. What you're going to do is you're going to sit there and say my dividend is equal to that amount times 0.2, which is equal to 1305332. Exempt dividend 1305332, and then you're going to have proceeds on disposal would be 100,000. Why 100? 500,000 times 20%. Cost 1 million. Loss 900,000. Loss disregarded 900 because my dividends are bigger. My taxable income will be 0. Now I can't really get much harder than that. So if you look at the 2017 year-end exam, there was something like that in there. But that's not hard, huh? Do you understand why they like to ask this? Because you get a company calc. Woo! Now, guys, you have a minute. Now, guys, just you know what the whole thing is with these things? Can you guys all calculate an accounting profit? Now you've seen the VAT, you know what to do with the VAT. You've seen the debtors. I know you all would have forgotten to do the debtors with the VAT. Now you know that you need to do the VAT. If you see deferred tax, does it make sense that you just reverse the deferred tax out? And then with liquidation costs, it makes sense. It's an accounting loss, but it's not a tax deduction. And, yeah. Just plug the stuff into the respective places and hunky-dory. Very, very nice. No, no. Guys, you know what the only thing is that they could do to make this harder? They could make one of the assets like a pre-2001 asset where that you needed to still calculate VAT based on market value. But basically, when you did base cost, you needed to do a greater of this or this or this. So they could do that to make it harder, but that's about the only thing that's not inside this question. Do you want me to post an example like this up onto your, with the model solution? So I'll take the latest board question that they asked on it, and I'll just put the board question up. Is that all right? Is that cool? It's got all of this stuff in it. Plus, I think it's actually, yeah, it's got basically this stuff in it. Because, do you understand I can't really make it harder than this? Huh? The only way they could make it hard, and I don't think they would, is if they said instead of selling one of the assets, they decided to declare it as a liquidation dividend. But you'll treat that as a dividend in specie, huh? But that's not hard. And they'll go out at market value. It's still the same calculation. So the calculation's not going to change. Guys comfortable with this? Okay. So there's a liquidation. Guys comfortable? You. Okay. It's not so bad, really. It really isn't. I know that you didn't really like that. Guys, the other thing that they can do is part C. So turn over now. And page 158 now. So sometimes what they'll do in a question is they'll actually give you the net effects of the liquidation. So the next two questions that I do with you are going to have where they give you the table after the liquidation's been done and ask you to do stuff with it. Is that all right? So I'm going to show you now. So in this question, it says Chile invested in garlic many years ago. Garlic was placed under voluntary liquidation on 1 April 2019. All of its assets were realized, and as a result, all liabilities were paid. The liquidators did not make any interim payments to beneficial owners of shares. They held 10% of the shares in Garlic. The cash in the bank amounted to 830 is represented by. So what they've done is they've given you the table after the liquidation. So what you're going to need to do, guys, is inside this question, because they've given you the table after the liquidation, you're going to have a dividend column and not a dividend column. Share capital, it says refer to stuff below. It says the contributed tax capital as defined amounted to 150,000. So guys, if you're looking at share capital and it's 200, what have they told you is contributed tax capital? 150. Therefore, 50 must be dividend. And guys, capital reserves, where's that going to go? Dividend column. And the revenue reserves, where's it going to go? Also into dividends. And you're going to add up everything, and you're going to get 150,000 here. And this one is 350, 630, 680,000. Guys, comfortable with that? And in the question, guys, what does it say? It says that you owned what percent of the shares? 10%. So you're going to go times 10% is 15. And times 10% here is 68. And they've asked you to do the tax calc of the company. So you're going to go dividend received, 68. Exempt dividend, 68. Proceeds, 15,000. Base cost, it said 14.5. Times 80% gives you 400. It's 112. Guys, comfortable? Is that all right? Okay, so now, guys, it's more likely for this test that they'll give you something that looks like that, and they'll ask you to do it, but they'll probably put it into the middle of a trust. So I just want to do a question where it's been put into the middle of a trust. Okay, so let me explain what I'm about to do with you. The question I'm about to do with you, first of all, they've given you an incomplete table. So they've got a liquidation, and they haven't done the column inside the table for the liquidation. So you're going to have to create your own column for that liquidation. And you're going to have to do this calculation. You're going to have to work out what's a dividend and what's not a dividend. Are you guys comfortable with that? So I want to just, it's not in this pack, it's in the other pack that I gave you. Now for the 4862s, it's in the pack that starts and looks like this. So please, can you turn to page 162? Hella Family Trust, Hella Trust. And can I ask you to read through Hella Trust, please? So it says, in 2014, Valencia Hella passed away, and the Hella Trust, a resident testamentary trust, was created. The Hella Trust is not a registered VAT vendor nor a share dealer. In accordance with the condition contained in the trust deed, half of the revenue receipts and accruals of the trust, but not a receipt or accrual of a capital nature, are to be distributed in equal shares to her grandchildren, Wilhelmina Nordia, 21 years old on 7 May 2018, who immigrated to the United Kingdom in 2016, and Nikki Nordia, 15 years old on 28 Feb 2019. And the other half is to be reinvested for their benefit until Nikki attains the age of 18 years. If either of the sisters dies before this date, her share will be allocated to the surviving sister. The trust is to be dissolved when Nikki attains the age of 25 years. So guys, first things first. Okay, Wilhelmina, non-res. So Wilhelmina, non-resident. Nikki is a minor child. And they get 25% of whatever they earn vested in them. Now guys, there was a trust in this question, not trust, liquidation. Is there dividends out of that liquidation? There is a liquidation dividend. And what's going to happen to the liquidation dividend? How much is going to go to Wilhelmina? 25%. And how much is going to go to Nikki? 25%. Do you guys understand? That, not the capital profits, just the revenue side of things. So we've actually got a trust dividend that I'm going to write in over here. Does everybody understand that? And we're going to have to create a column. And we may also have to create a capital receipt column over here as well, just as a matter of interest. Is that okay? But no one has got any rights to capital, because what did the question say? You only have got vested rights to income, not to capital. So it says, Valicia Heller bequeathed a substantial cash sum. The trustees, Albert, father of Wilhelmina and Nikki, and two other independent persons invested this inheritance in local and foreign investments. Now, I need you to understand something, guys. Is there trustees' remuneration in here? They've actually modified it. Okay, so it says after trustees' remuneration. See note 3. We'll get onto that now. So Albert is one of the people that you need to do a tax return for. You need to remember there are 3 trustees. And when we get to note 3 with the trustees' remuneration, what are we going to have to do? Divide it by 3 and give Albert his 1/3 share. Does everybody understand that? So just be careful where one of the people you need to do a tax return is also a trustee. You mustn't forget to give them their share of the trustees' remuneration in a solution. Is that okay? So we'll get there now. It says the trust obtained a loan from the bank for the acquisition of the flats under an arm's length transaction at a fixed interest rate of 8% per annum. Oh, sorry. Just let me finish, sorry. It says the purchase consideration settled by an interest-free loan from Albert Nordia. Okay, so you've got an interest-free loan from Albert Nordia. Okay. Actually, sorry, I'm going all over the place. Sorry, I'm starting at the wrong place. Sorry. Let's just start here. On 1 March, Albert, 55, married out of community of property. Okay. A resident of the Republic, father of Wilhelmina and Nikki, sold 2 flats on the Cape Town waterfront to the Heller Trust at a market value of 3.4 million each. Purchase price settled by an interest-free loan. So what are we going to do, guys? We've got rentals. Who's the donor for the rentals? Albert. Okay. Flats are let to local and foreign tourists for a daily, weekly, or monthly basis. None of the beneficiaries have a vested right to the income or capital of these assets. The trustees can use their discretionary power to distribute any amount to the beneficiaries. It says the trust could have obtained a loan from a bank for the acquisition of the flats under an arm's length transaction, being a fixed interest rate of 8% per annum. It therefore saved interest of $544,000 for the year. The official interest rate is 7.75. Are you guys comfortable with that? So what's going to happen, guys, is there's going to be a woolage limit on the rental column of 544. What's the total income in this column? 240. So woolage limit is not going to apply to this column. Are you guys comfortable with that? Is that cool? Okay. As far as the other columns are concerned, this is no donor and no donor. Why? She died. She passed away. Are you guys comfortable with that? Question continues. Note 1. On 31 Jan, the Heller Trust received a distribution of 168 as a first and final dividend from Odia, a resident company that is in the process of being wound up. The liquidators did not make any interim payments to shareholders. The Heller Trust held 5% of the shares in Odia. The trust acquired 5% of the issued share capital for $20,000 3 years ago. The market value of the shares of 5% was 15,000 Rand on 31 Jan 2019. You've established that the 168 liquidation dividend is made up as follows: 20, 25, 160, and 37. So let's just do it in a table. So CTC is 20, and then it's 185. That's a dividend. And remember, what do we need to put in tax returns? Gross dividends or net dividends? Gross. So it's 185. The 37 dividends tax, for purposes of our tables, is irrelevant. We need to put the gross amount into our tables. Is that all right? And 185,000 times by 25%, which is a vested right, 46,250, is going to be given to Wilhelmina, and 46,250 is going to be given to Nikki, and the 92,500 is going to be undistributed at the end of the year. Are you guys comfortable with that? And the contributed tax capital is 20, and how much did the shares cost? 20. So how much is our capital gain? 0. But do you understand that? I'm just going to sit there and go 0 and 0 here. But if it was like 10,000 capital gain, you would have put the 10,000 into undistributed because no one's got a vested right to capital. Are you guys comfortable with that? Carrying on. So that's not difficult, huh? You guys see what I just did? I just created a column for the liquidation in the middle of the trust. Note 2, it says on 15 March, the trustees of the Heller Trust sold listed shares in a resident company for 600. So I sold it for 600. Shares were purchased in 2016 for 340. So their base cost is 340. Okay. Okay. And the trustees' remuneration amounted to 12,000. Happy? So I need to sit there and say 4,000 is going to go to Albert for trustees' remuneration on the sale of the shares, because he's one of 3 trustees. And if there's 12,000 trustees' remuneration, each one gets 4. Okay? So the total amount is 260, 248. Is that all right? And how much has been given to Wilhelmina? 150 goes to Wilhelmina, and that leaves you with 98 for the trust. Guys, comfortable with it? The total trustees' remuneration, excluding the 12,000, amounted to 60. So there's plus another 20,000 trustees' remuneration for Albert, because you're going to have to do Albert stuff. Are you guys comfortable with that? Just have a look. Wilhelmina, what is she? She's a non-resident. So guys, what's the rule if you distribute capital gains to a non-resident? There's an anti-avoidance section in the Act which says that if you give capital gains to a non-resident in a trust, the trust pays tax on it. So if you ever see a non-resident being given a capital gain, the trust gets taxed on it. Are you guys comfortable with that? So the trust is going to be taxed on the 150 plus the 98. And then it's just a process of going through the table, guys. So this 40 that goes to Nikki, who's going to get taxed on the 40? Albert's the donor. Nikki is his minor child, so who's going to be taxed on the 40? Albert, 7.3. The 60, who's going to get taxed on it? She's a non-resident, so who's going to get taxed? Albert, 7.8. And this 140, no one's got a vested right, therefore 7.5, who's going to be taxed? Albert, because he's still alive at your end. Is that all right? And everything else, what's going to happen inside here? It's going to go to the beneficiaries. However, I need to just go through this with you nice and slowly. So guys, do you understand the rental column? 7.3, Nikki to Albert. 7.8, the non-resident to Albert. 7.5, the retained income to Albert. Next thing, guys, there's a foreign dividend, guys. And the foreign dividend is 112502 Wilhelmina. Now she's a non-resident, guys. So what are you going to put in the solution? Dash. Because it's a non-resident receiving a foreign dividend. It's a dash. It's not SA source. So what happened inside the solution when I marked it, guys, is guys got the right net answer at the end of the day, but they didn't set out properly. So that 11,250, you're actually supposed to put a dash in the solution and say it's not SA source. It's a non-resident receiving a foreign dividend. It's not taxed in South Africa, dash. This 11,250 that goes to Nikki, you'll put it into Nikki's gross income, but because it's a foreign dividend, what are you going to do? Minus 25 over 45 times by 11,250 is your foreign dividend exemption. Guys, happy with that? Then there's local dividends, 11.5. And you're going to say to Wilhelmina, 11.5 in, 11.5 exempt, because local dividends, SA source. For Nikki, 11.5 in, 11.5 out, local source. The foreign interest now, this 3625, again, it's going to be a dash in the non-residence tax return because it's a non-resident getting foreign income. And this 3625, you're going to put it in, but there's not going to be an exemption because there's no exemption for foreign interest earned by an SA resident. This 24 local interest, it's going to go in Section 10(1)(h), because a person's outside SA for more than 183 days, not a permanent resident, not residents, not carrying on business, out. Okay? And then you're going to say 24,000 times 15% is going to be your withholding tax. Are you guys comfortable with that? Because there's withholding tax on interest. The other 24 is going to go in for the resident, for Nikki, 23.8 exempt. Is that all right? Okay. Then the contingent amounts on the bottom of the page, they're all going to go to the trust. So these amounts are contingent. They all go to the trust. Is that all right? The trust gets a dividend exemption for local dividends. It's going to get a 25 over 45 exemption for foreign dividends. Are you guys comfortable with that? Okay, so treat it normally. The trust dividend here, guys, the 46,250, that's going to be in, but exempt for Wilhelmina. For Nikki, 46,250 in, but exempt for Nikki as well. Are you guys comfortable with that? And if there was a capital distribution, this capital on this side goes to the trust. If you guys want to just try to do this by yourselves at home. Is this all right? The other thing that they can do to make life more difficult, guys, is sometimes they put the net foreign dividends in here. If they give you a net foreign dividend, what are you supposed to do? Gross it up. Is that all right? The other thing that I've seen them do in questions is they've had someone emigrate during the year. So with the distributions column, can you see here? They actually put down dates next to the distributions. So they say the first distribution was on, say, the 31st of March, and the second distribution was on the 30th of November. And they say the person emigrated on the 30th of July. So what you'll do is the first one you'll treat as if they're a resident, and the second one you'll treat as if they're a non-resident. Is that all right? Similarly, they could have Nikki getting married in the question. And they'll put dates down, and she'll be 7-3 will apply before she gets married, but it won't apply after she gets married. Or if she turns 18 in the question. Does everybody understand? So they sometimes put dates in. So I'm just trying to actually preempt something that you haven't seen before. Is this all right? Do you see how they might ask you to create a column by putting a little bit of a liquidation in or doing something like that? This is not so bad. Will you try to do this? Can I tell you what happened in the when I marked? Okay. It was one of the strangest things, and I just want to actually just go through. Remember, I've spoken to you about the in-out principle with income and exempt income. So guys, here's Wilhelmina, dash and dash for the two foreign amounts. So you've got to put 11.5 in, less the exemption. 24 in, less the exemption. 46,250 in, less the exemption. So when I did the marking for this, the vast majority of people dropped 8 marks because there are actually 8 things in the question. Actually, there's more than 8, actually. If you actually have a look here, down here for Hella Trust, there's 115 in, 115 out, 22.5 in, and then there's an exemption there as well. So what people did was they said, dividend exempt, dash. Do you understand you get 0 out of 2 for doing that? Do you understand if you go interest, exempt, dash? Okay. Now, let me explain something that's very, very clear inside this question when you look at Wilhelmina. Okay. You've got dashes in this question. What does a dash mean? It means it's not taxable. Okay. If you put a dash in, it means not taxable. So for that local dividend there, the 11,500, less the exemption, 11.5. If you put a dash in, you're telling me it's not taxable, which means I give you 0 out of 2 for it. The vast majority, there were oaks that dropped like 8 marks and 10 marks in this question because they actually didn't set out properly. Guys, if it's income, it goes in as income. If it's exempt, then it goes out as exempt income. You get 2 marks for doing that. If you do not set out properly, you're going to be in trouble. And I know people have got these habits from undergrad where you see dividends with a dash in your third year stuff. You need to put it in and then take it out. Okay? That's what happens in a postgrad environment. And the guys failed not because they couldn't do anything, but because they were under time pressure and they were going dash, 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 dash. Are you guys comfortable with this? So hopefully, I just want to just point out, do you understand the difference between a dash, which means not taxable, and then 11.5 in, 11.5 out, which means it goes into gross income but exempt? Will you set out properly? Because that is what I worry about more than anything. When I mark for UNISA at the end of the year, that is why people fail. It's not because they can't do tax, it's because they do that and they fail because of it. And traditionally in a year-end exam, you'll drop 10 marks in any year-end exam. This class test, people happen to drop 10 marks because there are 10 marks out of the 35 available is for that. And people didn't set out properly. And you either get 0 out of 10 or 10 out of 10. It's the most amazing thing, because if you do it if you put dashes down, you always put dashes down. Is that all right, guys? Is that okay? Okay. I want to go forward a little bit. Okay, so can I ask you to go forward to this question, question 9. Sure. And I want to go forward to solid bridges. Page 177, part B. Can I ask you to just read through this? So this is a discussion question on trusts. So I want you to read it first, and then we're going to go through and we're going to have a practical discussion on how to answer a trust discussion question. Okay. Before we do a discussion question, I just want to have a basic pragmatic chat to you about trust discussion questions. So first things first, guys. What I think that you need to do is you need to see who you're writing the discussion for. This question doesn't actually ask you to write it for anybody in particular. Okay, so this one's okay. But often what they'll do is they'll say, listen, you need to write a discussion question. You need to explain to a 16-year-old child how they're going to be taxed. Does everybody understand? If that becomes the case, what do you need to do when you actually answer the question? You've got to understand that you're writing it for a 16-year-old child who's got no tax knowledge whatsoever. So you need to get down to really, really basic shit, and you're going to need to explain certain things to that person. So you're going to need to explain to them what a vested right is. You're going to need to explain to them what a contingent right is. Does everybody understand? You can't just go sit there and start talking about vested rights and contingent rights, because the person's not going to understand what it is that you're doing. So let's just discuss pragmatically before we start a theory question, what things should actually be put into a discussion question for a trust. Is that okay? So let's just go through the stuff. Number one, okay, you need to discuss the concept of conduit pipe principle, that something that goes into a trust retains its identity as it flows through. Does that make sense, guys? You're going to need to explain vested rights and contingent rights in terms of section 25B. So let's just go through the theory there. 25B1 says what? If the trustee gives you rights to something, vested rights, it's taxed in the beneficiary's hands. That's 25B1. 25B2 says if the trustees exercise their discretion and give you something, then you'll get 25B2. Is that all right? 25B3 says if you get the income, you also get the expense. And 25B4 says if you get a loss from a trust, you can set it off against other trust income. Are you guys comfortable? Then you've got section 7. What does section 7 do? We've got 7.2, which is for spouses. Got 7.3, which is for minor children. Got 7.5 is for undistributed income out of a trust. 7.8, which is for non-residents, and 7.9, which says interest-free loans or low-interest loans are treated as donations. Remember 7.9 that I showed you earlier? Guys comfortable with that? And we're going to need to incorporate all of that into our discussion. So watch what's going to happen here, and I'm going to ask you to read through the solution now. And then the other thing that you need to do, guys, is please just remember the moment there's a low-interest loan, you've got section 7C, which you're going to need to put in. And the moment there's low-interest loans, you're also going to have the Woolwich principle. Does everybody understand where I'm coming from? So we might have Woolwich as well. So it says Solly Bridges is 56 years old, married out of community of property to Susan, his second wife, and a very wealthy SA businessman. He is has a local investment portfolio worth 13 million on 4 March 2018. He called you his tax practitioner to inquire about the tax implications. If he was to transfer 20% of his investment portfolio at market value to his family trust on 4 March 2018. So guys, it's on 4 March. So please just remember when you actually do your interest calculations, it's going to be times by 361 over 365. Is that all right? So please, it's 4 days into the year. You've got to take the 4 days off. So times 361 over 365. It says the trust will finance the transaction through an interest-free loan. Okay. Assume the official interest rate is 7.75%. Also the market value for purposes of this question. So guys, Woolwich and the donation will be at the same rate, although they're not normally at the same rate. Woolwich is normally at a different rate. So times 7.75%. Okay, the trust will finance the transaction. So guys, he's transferring 20% of his investment portfolio. Are you guys comfortable with that? So 20% of the 13 million rand market value investment portfolio. So guys, when you do section 7C, what are you going to do? You're going to say there's an interest-free loan, section 7C deems a dividend to take place, and not dividend, a donation to take place, based on the interest that hasn't been charged. Calculation 20% times 13 million times 31 over 365 times 7.75% equals, can we just guess, say 200,000 bucks, is that right? Donation, he hasn't made another donation during the year, therefore 100,000 is exempt. 200 minus 100 times 20%. Donations. Happy? In addition to that, guys, what you would need to do, and it's not in the solution, but it should be, you would sit there and say the proceeds of, you're going to need, because it's between a connected person, the investment portfolio is deemed to be sold at market value. Are you guys comfortable with that? Less your base cost, there'll be a capital gain. And you're going to have to add, there's no donations tax in the question for, because it's an interest-free loan, it's a sale. And you're going to have that in there as well. Guys comfortable with this? Cool. You're also going to need to discuss woolage, and it'll be a woolage limit based on the same numbers. Are you guys comfortable? I'm going to let you read through the solution now. It says the trust was founded in 2008 when his father, Emil Bridges, died. Beneficiaries are Alida, Solly's daughter from a second marriage, 15 years old. So that's going to be 7.3 when we discuss it. Scott, his son, who's 27 years old, immigrated to London. That's going to be 7.8. It says in his valid will, he bequeathed the rent-producing property with a market value of 7.8 million to the trust. So when we start discussing this, guys, you need to sit there and say, first of all, you should put in 25B3. So you're going to say, rental income will go in, but the rental expenses will be set off against the rental income in the same column. And if there's a loss, it's ring-fenced in terms of 25B4. Are you guys comfortable with that? Is that cool? The guy's dead though, huh? So that's not going to be subject to section 7. So you would probably, as part of your discussion, say, because the guy's dead, section 7 can't apply to this transaction and it can only be taxed in the hands of the beneficiary or the hands of the trust. Are you guys comfortable with that? Okay. It says Emil stipulated that the net rental income should be distributed equally to the two beneficiaries. If one of the beneficiaries were to die before Aleda's 25th birthday, the undistributed amounts will form part of his or her estate. So they've got vested rights. They're going to get their share of the stuff. Is that all right? No matter what, they get half each. If Solly's been estranged from his son, he stipulated the returns of the investment portfolio should only be applied for the maintenance and school fees of Aleda at the discretion of the trustees. In the event of her death, the undistributed amounts will not form part of her estate. The trustees will have the option to donate the income and capital to any charity of their choice. So if she does. So whatever gets given to her, she's got a vested right. But because he's a donor, section 7 will apply to that part of the transaction. So let's turn over. So we've got two columns, guys. So the investment returns column over here. When you discuss, you're going to say section 7 will apply because this is from a donation. Interest-free loan. Are you guys comfortable with that? Okay. You're going to have to discuss that. You're going to say to Aleda, section 7.3 is going to apply. Are you guys comfortable with that? Anything to Scott, section 7.8 will apply. The 80,000 retained in the trust, section 7.5 will apply because the donor is still alive. There's a stipulation in the trust deed and no one's got a vested right to it. Happy? When you're dealing with the rental income column, you're going to say no donor. Donor is dead. Therefore, section 7 can't apply. 90,000, 25B1 given to Aleda. 25B1 given to Scott. Okay. Guys comfortable with that? And you're going to have to discuss woolage and section 7C. And you need to discuss conduit pipe principle as well. And you're going to need to discuss the concept where people have got vested rights and don't have vested rights. So can I ask you to just have a read through, or let me read through it with you? So it says the sale of 20% of Solly's share portfolios at market value, there's no donations tax. Guys comfortable? However, it's a disposal of an asset in terms of the 8th schedule in a CGT event. Proceeds will be at market value as they are connected persons. Can't do base cost because I didn't tell you what the base cost was. In terms of Section 7.9 and case law, interest-free loan account is a donation, settlement, or other disposition. Okay? It says as the trust is merely a conduit pipe until it reaches the parties, the investment returns will retain their nature. Section 7.3, the 50,000 distributed to a later will be included in Solly's income. As no investments, returns are distributed to Scott, no income in terms of 7.8 will be taxed in Solly's hands. I hate it when they do that in solutions. But if it's a 0, just say 7.8 doesn't apply because there's nothing done. And then the residue will be taxed in Solly's hands in terms of 7.5. And then, guys, they don't tell you whether it's dividends or interest, but you need to say in the question, if it is a local dividend, it will be exempt. If it is interest, it will be subject to an interest exemption. Because it says investment returns. You don't know what it is in there, so you're going to have to add on those two things. Guys, sorry, just look at rental income first before we look at willage and the other one. Rental income, it says none of the provisions of Section 7 is applicable as the original donor is deceased. An income-producing asset was bequeathed to the trust. They both have vested rights to the rental income. 50% is included in Aleda's income, 50% in Scott's. They can claim deductions in terms of 25B3. If they're losses, they can claim it in terms of 25B4. It says as the amount will be included in the gross income have vested rights in terms of 25B. There's no tax implications for the trust, so the trust gets taxed on nothing. And then Section 7C, guys. If Solly is a natural person who provides an interest-free loan to the trust, Section 7C will apply. So only applies to natural persons, provide interest-free loans. An amount equal to the difference between the official rate, 7.75%, and the interest paid in the loan account will be deemed to be a donation. There's the calc, 20% times 13 million times 7.75% times 361 over 365, 199,292 deemed to be a donation. Came 100 off it and then times the difference by 20%. Willage, just the limit. And I told you market value was the same as the official, market rate of interest is the same as the official rate. So it's there. So, as the investment is financed through an interest-free loan, willage applies. In essence, it means that the income attributed to Solly will be limited to the interest foregone on the 20% investment. Income in terms of Section 7 allotted to Solly will be limited to 199,292. That's not here. Guys, comfortable with this? If you get a discussion questions, give you a bit of an idea. 4861, guys. Seriously, I think you should look at this one. I know it's not one of the ones that they ask you to do. But if you ever get a discussion, there is a discussion question inside your assignment, not in the test section, but in the other section. This is a really, really good discussion question to look at just to get your bearings right for a trust discussion question. This is the 2017 class test, okay, for 4862. So this is part of the 2017 class test for 4862. Okay. Very, very good one to look. So like, you know, I've always advocated you've got like a little sheet where you instruct yourself to do things before exams. I would always go and write a little note to myself to go and have a look at this discussion question just to get your bearings right for a trust question discussion for an exam. It's a really, really good one to look at. Do you guys see it? Discusses vested rights. Doesn't have contingent rights here, but it's not going to discuss those. But it's got annuity income conduit pipe, the way that it sets out everything. Are you guys comfortable? Plus, this one is quite complete from a discussion perspective. Guys, comfortable? Okay. One or two more things that I just want to do quickly before you finish. Okay. Note 3, guys. Okay, this is examinable for both 4861 and 4862. This is the only instance in either the 4861 TATs or the 4862 TATs where they've got this principle. I'd just like you to read through it, please. Just read through it. Okay, so let's go. says Premier invested in Breweries PLC, Brew 6 years ago, 1,500 shares at 6.20 per share. Brew has its primary listing on the London Stock Exchange, secondary listing on the JSE. So what happens with your listed shares, guys? Treated as a local dividend, huh? So even though this is a foreign company, what happens when it declares a dividend to you? It's still treated as a local dividend, but there's a trick with this. So I just want to go through this. So it says on 1 June, Premier received an amount of 180 after withholding tax of 10% was deducted. So you guys are going to have to say it's 180,000 times 100 over 90 gives me 200,000. So inside the solution, if you have a look on the next page, guys, you'll see that there's a dividend of 200,000 received less 200,000 is exempt because it comes from a dual listed company. Are you guys happy with that? Therefore, what's going to happen? Guys, it's exempt. Happy. But I need you to turn over to this part of the solution because it also asks you to discuss dividends tax consequences. And I want to start from there where it says the foreign dividend received from breweries. Okay? There is a trick. Now, before we start reading through this, I need you to understand there's foreign withholding tax. And you can take that withholding tax from the foreign company and you can set it off against your dividends tax in South Africa. Is that okay? So the way that it works, it says the foreign dividend received from breweries of 180 was distributed to natural persons who are resident in the Republic and not exempt in terms of Section 64F. So if this comes to a, guys, if this comes to a SA resident, not a company. If it goes to a company, do you understand there's no dividends tax? But if it's being given to a resident, guys, the way that it works is, it says the 180 was distributed to natural persons who are residents in the Republic. Okay. So what they're saying is if you've got the dual listed, okay, and then they give it to an SA company, and then what the SA company does is it gives it to SA residents. Okay. The dividend is 180. It's not 200. You guys understand? Because what does the SA company receive? Just 180. Is that all right? And what you're able to do is you sit there and say, listen, because it's given to SA residents times 20% gives you dividends tax of 36. But when Premier declares its dividend, it's allowed to take off the 20,000 Rand withholding tax off its dividends tax calculation. Okay, because it's saying you're actually paying dividends tax twice on this dividend. First of all, you paid it when it came into the company. You get to take it off when you pass it through the company through to the other shares. So just read through it. It says the foreign dividend 180 distributed to natural persons. In terms of 64N, the total dividends tax should be 180 times 20%, which is 36. Less the foreign tax rebate of 20,000. Do you understand where the 20 comes from? Which leaves you with 16. The liability, therefore, rests on the beneficial owners of the shares and has to be paid before 31 July, end of the month following the declaration. Who needs to pay it and when? So if you ever see dual listed shares and there's a dividend that flows through, will you remember to do this, please? Is this okay? Just happy with this? Okay. I just want you to just remember that. So if you see dual listed shares, just remember that when the eventually gets paid out by the next layer of shares, you can take the withholding tax off and when you're doing the next dividend payment. Are you guys comfortable with that? So, yeah. Now, you know what you put on a fuck-up sheet? Please put that on a fuck-up sheet so that, like when you're reading and you're learning for your exam, just remind yourself to have a look at this part of the question. Okay? And like, sorry, it's just, I know I'm being a bit pedantic with this, but like, what I would do is I'd do something along these lines. I would go and I would highlight this out, and I would, on my fuck-up sheet, explain what you need to do with it, and then say, go look for, on this page of the assignment, go look at the highlighted stuff in yellow, and make sure you know you go through it. Okay. It's one of those things. You either get full marks or you get nothing. But you can lose 5 marks if you don't do it properly. Is that okay? So that's just with dual listed. Okay, let's look at number 1, guys. It says just a normal share transaction thing. So this one. It says on 30 May. Actually, and can I ask you to just look at the solution as I go through this with you? It says on 30 May 2017, purchased. Actually, let's start at the top. Premier Invest is a company with the June financial year end that invests and trades in shares. So it's a share trader. So this is trading stock. Premier Invest holds South African equity shares as its trading stock and applies the FIFO method to value its stock. Premier also holds investments in foreign shares on long-term investments, longer than 3 years, except that the trading taxable income is 2.1, so you'll put the 2.1 in. On 31 May, Premier invested 6,000 shares in Robex. Robex is a resident company listed on the JSE at 850 a share. So your opening stock deduction is going to be whatever that calculation is, 6,000 times 850. Are you guys comfortable with that? Okay. During the 2019 year of assessments, Premier Invest speculated Robex shares would significantly increase, and on 1 Jan, they purchased a further 2,000 shares at a cost of 720. So 2,000 times 720 is going to be a purchaser's deduction of trading stock. Okay, on 15 Feb, when the market value of the shares had increased to 980 per share, gave 200 shares to each of its 5 executive directors and shareholders. Each has a 20% shareholding. So guys, this is a dividend. So they gave 200 shares to each of the 20% shareholders. So what do you deem to have done? Sold it at market value. And then for the discussion on the next page, you're going to have to say it's a dividend in specie deemed to be sold at market value, dividends tax of 20% of that amount equals this, payable by the end of the following month. Are you guys comfortable with that? So that's not on page 176. That will be on page 177. It says 2 days later, when the share price had increased further to 1065 per share, Premier sold all of its remaining shares in Robex at market value. So how many shares is that? You had 6,000 plus you bought another 2,000 is 8,000. You gave 1,000 to directors, so 7,000 shares times by 1065. That's going to go into gross income. Then says Premier Invest received a cash dividend of 50,000 in its bank account from Robex on 31 December 2019. Guys, it's a company, therefore there wouldn't have been any dividends tax, so you don't need to gross it up. So you're going to put 50 in and 50 exempt. Number 2, Premier holds 20% of the equity share capital of Energix, not a controlled foreign company, purchased in 1 June for 189.5. Energix is a foreign business establishment not listed on a recognized stock exchange. The average exchange rate for the year is equal to 13.50, and the spot rate on 30 April 2019 equals 14.10. So guys, for a company, what are they required to use to record stuff? Spot, eh? Okay. It says on 28 Feb, you received a foreign dividend of £34,000. So 34,000 euros, times by spot will go into your gross income. Is that all right? Because you own 20% of the shares, what happens? Full amount's exempt. Are you guys comfortable with that? It says Premier Invest decided to sell their 20% shareholding to another foreign company for 50,000 euros. So 50,000 times spot. Are you guys comfortable? Less the amount, there's a gain there. And remember, I did 64B with you. What did you need to do? Own more than 10% of the shares, sell it to a foreign company, and you need to have owned it for more than 18 months. Do you remember what I showed you at the beginning? So there's section 64B. Is that okay? Happy with this? This is cool. Okay. I can't finish the last one I wanted to do with you, but I will do it with you next week, in addition to some other stuff. So guys, all I tried to do tonight was I basically looked at questions and I tried to pull out something from everything in the syllabus just to do revision with you tonight. Is that okay? So if you want to go through all of the questions that I've done with you, I can't cover 100% of the stuff, but I've probably covered 95% of the syllabus tonight. Is that okay? You've got a test on Sunday. I'm going to go through the paper with you and mark the paper with you in class on Tuesday next week. Is that all right? Can't cover everything though. And I'm going to pull out some questions. Next week though, at about the 4861 guys, okay, I'm going to do it at a 4861 level up until about 9 o'clock next week. The last hour next week is going to be at 4862 level. So what I want to do is I just want to do last year's year-end exam question with the corporate rules in it with you guys. Do you want to have a look at it beforehand? It is actually posted up on the thing, so, but I'll go through it with you. So next week, 4861 up until 9 o'clock. I'll make sure that I'm doing things that are examinable in both papers. And then I'm going to go through what was in the year-end exam last year with you guys, because I'm just worried. Sometimes they take questions out of last year's year-end exam and they dump it into the class test. So I just want to go through around about those 80 marks worth of questions and just hand it out to you and just make sure that you're comfortable with the stuff for your test. Is that all right? Cool. Okay, docs. I'm not going to, some of the tests from the year-end exam last year I'll do before 9 o'clock, the ones that is applicable for 4861. Okay. Cool, guys.